Hey team, welcome back to the Brent Bruce Daily. Today is March the 15th, 2023, and there is still so much going on in the market. It's now 5:21 p.m. Central Time because I'm just trying to digest all the information and see where the markets ended for the day. The issues with Silicon Valley Bank and now some of the other smaller banks has spread and even started to touch some of the other countries. You're starting to see this showing up in Europe, and that's still causing people to be afraid of what is going to come of this issue. It's causing them to move their money again from the overall equities and stock market and buying bonds. Bonds are improving greatly because of the turmoil from Silicon Valley Bank and Signature Bank. Now, the other thing that we were watching closely is the producer price index that was coming out today. We know we had a pretty good report for the consumer price index yesterday. The producer price index is number 4 on my list that we always talk about. The Federal Reserve making their adjustments, the personal consumption expenditure, the consumer price index, and now the producer price index. And check this out. Some people are saying that inflation is still going through the roof. It's not coming down. Today's producer price index report for the month of February showed the month-over-month headline reading -1. -1. Okay, so they were expecting a 0.3 increase, something that we're kind of used to hearing, 0.3, 0.4, 0.5. I'm always looking for that 0.2. It came in at -1. It was some adjustments to some of the prior months. We are now seeing the headline producer price index at 4.7% year over year. Now, to really give you some perspective, you need to understand that this number at one point was almost 11%. Inflation being gauged by the producer price index was almost 11%, and now it's coming in at 4.6, 4.7%. Inflation is coming down. We are going to see the benefits of inflation coming down roll over into the mortgage-backed security market soon. Now, I'm hoping that we're going to see it, this week. But we may not. We still have ups and downs in the markets. We are improving today, though. So let's take a look and see how the markets are responding to a -1 on the producer price index for the month of February. So let's jump over to our charts here. Taking a look, what do you know? After a strong improvement from the producer price index report, we are up 50 basis points. And again, you guys, it's 5:23 p.m. Central Time. And we're up 50 basis points and the market is closed. So that is what happened today. It is not going to go back down today. Look at the 10-year Treasury, down 21 basis points. Now, if you've been watching the Brent Bruce Daily for a while, you're probably looking at that number going, I don't know that I've seen the 10-year Treasury go down 21 basis points in a single day, but at least for a very long time. These are tremendous improvements to the bond market. We're now at 3.462. Take a look at where we are over here. Yesterday, I was saying how I was hoping that we would close and stay above this 50-day or 100-day moving average as a floor of support. Well, take a look at where we are now. Now the 50-day moving average is our floor of support. We still are going to have this Fibonacci level just overhead, but look where we went today. We went all the way up to just about 101. So this is about where we stopped last time on a run. So this is definitely going to be some sort of a psychological number that we need to get through this 101. You can see right there, it shows 100.95 just off to the right. And then what do we have above us? The infamous 200-day moving average. Let's take a quick look and look at the same chart for the 10-year Treasury. But remember, when we're looking at the 10-year Treasury chart, this is a chart that shows yield, not price. And what that means is that you want this chart to show it going down. And you can see that we're going down, big moves down, breaking below these floors, which were actually floors of support. We didn't want that. We want to break through these. And boom, what did we hit on? We are sitting on the 200-day moving average. And this is a tough customer. We're going to have to fight hard. Now, what is it that's going to break us through the 200-day moving average on both of these charts? Well, on the 20th and the 21st of this month, we're going to have the announcement from the Federal Reserve. So next Wednesday is the announcement from the Federal Reserve as to what they're going to do with the federal funds rate. And guys, this is really going to be interesting because we had people pretty well locked in saying that we're going to see 0.25% increase in the federal funds rate. I mean, I would say that I would almost put my money on that. But then we had some reports coming out especially, throughout the month of February, especially allowing people to begin to start talking about the Fed to increase the federal funds rate by a half. So, we need to be more aggressive. We're not seeing inflation responding like it needs to. Now we have the occurrence of Signature Bank and Silicon Valley Bank. And now all of a sudden the Fed's going, wait a minute, they're stepping in or talking about stepping in to keep from a disaster happening in the banking industry. Is this the right time to be raising the federal funds rate? There's people right now that are calling for them to bring it down immediately. So does it make sense that maybe with this turmoil and some, there's a lot of reason to believe that these bank failures are directly because of the Federal Reserve increasing the federal funds rate? So are we going to now continue to increase the federal funds rate? Or is the Fed going to take this as, I want to say a shot across the bow, but really it was pretty much a hit. So are they going to increase the federal funds rate? Are they going to say we better stay calm and only raise it a quarter, which was what the market might be able to take? Or are they going to say, you know what? Hold on. We need to take a moment and look at what we've got going on. There's too much going on in the banking industry right now for us to increase the federal funds rate. We can do it again later, but not this time. And if they do that, here's what we really want. If they pause and they do not raise the federal funds rate on the 20th and 21st, next Wednesday, they're going to allow more reports to come in showing inflation subsiding, showing the effects of the moves that they have already made. And then they might be able to say, you know what? We actually are in a pretty good position and inflation is coming down. Let's just continue to hold. And they're going to hold for a long time. I mean, let's just put in our heads they're going to hold for 9 months to a year. If we think that way, then when they start to bring it down, we can just be excited because they bring it down sooner than that. That's going to allow, again, more reduction in home loan interest rates, because once they get inflation back under control, they want to bring that Fed funds rate a little bit lower than where it is right now. So we have the announcement by the Federal Reserve next Wednesday. And then on the 31st of March, we also have the personal consumption expenditures report. So those are the two reports that are going to be coming out. Now, the hottest topic still is the issue with the banks. That is still the biggest issue. So we need to pay close attention to that. And again, that just took center stage. I mean, a week ago, we weren't talking about it, right? So that took center stage as anything can. So you're seeing how this all works. Let's take a look and see where home loan interest rates are at this point. Longer videos lately, but you got to understand, this is like big news, big market moving news that we're seeing, I mean, almost on a daily basis here. Let's pull up our scenarios for the Brent Bruce Daily over here. What do we got here? Got it. Let's take a look and see what we have for the very well qualified 30-year fixed conventional home loan on a day that we have a 50 basis point increase to the mortgage-backed security. Now take a look, 6.49 with a credit of 814. This is almost exactly what we had yesterday. So are you seeing how the banks are not comfortable? They're not comfortable passing along the savings that they're getting right now. They're not comfortable passing that along to the actual interest rates that consumers are getting. They're holding back. They need more reassurance that this isn't something that we're going to go a few days from now, things are going to settle. The Federal Reserve comes in and they step in and they save these banks and things settle in the banking industry and everyone goes, you know what? I want to take all my money back out and I want to dump it right back into the stock market and the equities market. And then it flip-flops the bonds against the stock market. And next thing you know, that money is coming right back out. I don't know what they're thinking, but this is kind of the way that I'm seeing what they might be worried about, because they clearly are not giving us the lower interest rates that the markets have given us. Because again, there's the markets, then there's the banks, then there's the brokers and the mortgage bankers and the consumers. So they get to kind of be in the middle where they can say, hey, there's all this gain over here. I'm getting my product a lot cheaper. Let's just put it that way. I'm getting my product a lot cheaper, but I'm not going to lower the cost to the consumer. I'm just going to sit there for a minute and I'm going to take a little bit of this revenue. All right. Now, again, part of that is because maybe they want some revenue, of course. Part of that is because they don't think that it's a good bet to hand that off to the consumer because they think it might get taken back from them very soon. Very interesting information here. So let's take another look here at the numbers. Open this up here so you can see my parameters. Make sure that I'm in compliance here. Very well qualified 30-year fixed conventional home loan. And what if we do want to see what it takes to get to that 5.99%. Hold on a moment, rerunning the numbers, opening this up. 11 Mortgage is still at the top right now. To get to a 5.99, it is costing just under a point with 11 Mortgage. All right, so let's take a quick look over. We like to see what United Wholesale is offering as well, because sometimes their buy downs are a little bit more effective. 5.99, again, there you go. See, this is why you want to use a mortgage broker, because I shopped the banks right in front of you and I found a 5.99% with almost a half of a point less than cost. And I do this with multiple banks. I usually only show a couple, but we do this with all of our banks. We shop to make sure that we're getting the best deal. Otherwise, if somebody just worked for one of these banks, they would say, here's my rate, and that'd be it. That's why you have to work with a mortgage broker that has many banks to choose from. So hope this is helpful. You guys, this is history in the making. If you're watching this, if you're turning on, I mean, I watch this stuff all the time, and I'm telling my family, man, they get so tired of hearing me. I'm telling my family, look, this is what's going to happen tomorrow. Look, this happened yesterday. We were listening to some discussions from the Federal Reserve talking about what if things don't work out in the banking industry. And I said, that's exactly what happened with Silicon Valley Bank. That is exactly what happened. And once it came back from the commercials, they go, Silicon Valley Bank. And they went into the fact that they were now discussing that Silicon Valley Bank collapsed or, went in default because of these exact issues. So you guys are starting to learn how this actually works by watching this channel and paying more attention to the bond market, the banking market, the equities. It's pretty interesting stuff. Let me know what your thoughts are. Make sure that you like, subscribe, and share, especially if you haven't subscribed already to our YouTube channel. That is very helpful to me. And pass this along to anyone else who might find it interesting. Talk to you again soon.